Welcome to StokTok's deep dive into Phillips 66. Phillips 66 is one of the largest downstream energy companies in the United States, operating across refining, midstream, chemicals, and marketing and specialties. At the time of recording, the stock sits at 156.37, well off its 52-week high of 190.61, and meaningfully above its 52-week low of 95.70. The RSI, or Relative Strength Index, a momentum gauge, reads 36.5, approaching oversold territory, which can signal a stock under distribution pressure. The 50-day moving average of 165.81 sits above the current price, while the 200-day moving average of 139.6 sits below it, a mixed technical picture. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Phillips 66 generates revenue primarily through refining crude oil into transportation fuels, operating midstream pipelines and terminals, and running a chemicals joint venture. Its diversified model across the energy value chain provides some buffer against pure refining margin volatility. The StokTok score comes in at 51 out of 100. A hold signal. Valuation scores a strong 17 out of 20. Financial health earns 15 out of 20. Profitability, however, is a concern at just 3 out of 20. Growth lands at 8 out of 20, and smart money registers 8 out of 20. A business with structural strengths offset by meaningful operational headwinds. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio for Phillips 66 sits at 14.45 times. That is, investors are paying roughly $14.50 for every dollar of trailing earnings. For a downstream energy company, that is not an aggressive multiple by historical standards. The forward price-to-earnings ratio compresses further to 11.58 times, which implies the street anticipates earnings improvement ahead. The EV to EBITDA multiple, enterprise value relative to operating earnings before interest, taxes, depreciation, and amortization, stands at 8.74 times, broadly reasonable for the refining and midstream space, where peers have historically traded in a similar range. On competitive moat, in our view, Phillips 66 benefits primarily from scale and asset breadth rather than classic pricing power. Its midstream and chemicals segments provide more durable cash flows than pure refining alone, which is a commodity-driven business. GuruFocus Value, an independent intrinsic value estimate, sits at 128.37 at the time of recording, implying the stock trades at a negative 21.81% margin of safety, meaning it is priced at a premium to that estimate. Wall Street analysts at the time of recording have a consensus mean target of 181, drawn from 20 analysts, with a high of 213 and a low of 138. The consensus leans constructive. The next earnings report is due April 29, 2026, with the street expecting earnings per share of approximately 0.04, a wide range from negative 0.95 to positive 3.33. reflecting genuine uncertainty. Market sentiment around Phillips 66, as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the balance decisively in either direction. In our view, the valuation is not cheap relative to intrinsic value models, but the forward multiple tells a more interesting story. Moving to financial strength, how solid is the foundation? The Piotroski F-score for Phillips 66 is 7 out of 9. This is a 9-point checklist that scores profitability signals, leverage trends, and operating efficiency. A score of 7 indicates a financially improving business in most of the dimensions that matter to a credit analyst. The Altman Z score, a model designed to estimate bankruptcy risk using balance sheet and income ratios, registers 3.65. Scores above 3 are generally considered in the safe zone, meaning near-term financial distress appears unlikely based on this model. Turning to the debt picture, the cash-to-debt ratio is 0.06. That is, the company holds very little cash relative to its outstanding obligations, which warrants attention. Interest coverage, the ratio of operating earnings to interest expense, stands at 3.11 times. This is functional but not generous. It means earnings cover interest costs roughly 3 times over, leaving limited buffer in a downturn. The current ratio, which measures short-term assets against short-term liabilities, is 1.30, modestly above 1, suggesting the company can meet near-term obligations. Debt to equity sits at 0.68, a moderate leverage ratio for an energy major with substantial fixed assets. The overall picture, in our view, is a balance sheet that is functional and not in distress, but one that offers less financial flexibility than we would ideally prefer. Next up, profitability. Is this business actually making money efficiently? This is where Phillips 66 faces its most significant analytical challenge, and where the StokTok score of just 3 out of 20 reflects genuine concern. Return on invested capital, the return the company generates on all capital deployed across the business, stands at 4.74%. For context, most institutional investors look for return on invested capital to comfortably exceed the cost of capital, which for a company of this risk profile might be estimated in the 8 to 10% range. A return on invested capital of 4.74 suggests the business is, at present, not generating returns meaningfully in excess of its capital costs. A structural issue worth watching. The gross margin is 9.85%, which is characteristic of downstream refining businesses, where the spread between crude input costs and refined product prices. The refining margin is the primary value driver and can compress sharply with commodity cycles. Operating margin narrows further to 2.55%, reflecting the cost intensity of the business. Net margin lands at 3.33%, and free cash flow margin, the percentage of revenue that converts into actual cash after capital expenditure, is 2.06%. These are thin margins by cross-sector standards, though they are not unusual for large integrated refining and midstream operators. In our view, profitability is the central risk to monitor in the Phillips 66 thesis. The business needs refining spreads to cooperate for margins to expand meaningfully. Onto growth. Is this business expanding, and at what rate? The revenue picture here is mixed and requires careful contextualization. Over the trailing 3 years, Phillips 66 has seen revenue decline by 8%, a contraction that reflects the normalization of refining margins following their exceptional levels in the post-pandemic commodity cycle. Investors who look only at this figure may draw a harsh conclusion, but context matters enormously in cyclical industries. Over the trailing 5 years, revenue has grown 14.6%, which captures the full cycle including those elevated margin years. This divergence between the 3-year and 5-year figures is the single most important growth data point in this analysis. It tells us the recent trend is one of cyclical deceleration, not structural collapse. Book value per share growth over the trailing 3 years is 4.6%, which is modest but positive, suggesting the underlying asset base and retained earnings are growing even as top-line revenues face pressure. The dividend yield at the time of recording is 3.11%, which is a meaningful income component for long-term investors in the energy sector. Phillips 66 has historically prioritized returning capital to shareholders through dividends and buybacks, and the dividend yield at this price level offers a degree of income cushion while investors wait for the refining cycle to potentially turn. In our view, the growth profile is that of a mature, cyclical business in a down cycle phase, not a growth story, but not a deteriorating one either. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier institutional investors, tracked as Guru-level allocators by Dataroma, currently hold positions in Phillips 66. That is a meaningful signal that serious long-term capital remains committed to the name despite recent price weakness. Looking at specific holders, Torre Funds has allocated 4.09% of its portfolio to Phillips 66, though it has recently reduced its position by 1.08%. A trim, not an exit, but worth noting as a cautionary signal from a patient, value-oriented manager. Bill Nigren of Oakmark Funds holds a 2.29% portfolio weighting and has been adding, increasing his position by 2.48%. Nigren is a disciplined value investor with a long track record, and an ad from him is a meaningful conviction signal. Tweedy Brown holds a small position at 0.13% of portfolio with no recent change, a hold rather than a directional bet. Turning to the broader institutional picture, only 10.6% of 13F filers, the quarterly institutional ownership disclosures required by regulators, are net buyers of the stock. The threshold we look for as a signal of broad institutional conviction is above 50%. At 10.6%, the data suggests the majority of institutional filers are not actively adding. Insider ownership stands at just 0.50%, meaning management holds very little of the company they run, a flag that institutional investors often view as a misalignment of incentives. In the most recent 3-month window, there has been 1 insider buy against 6 insider sells, a pattern that, in our view, warrants caution and merits monitoring over subsequent quarters. And finally, the verdict. Let's bring it all together. On valuation, the setup looks moderately interesting to us on a forward earnings basis at 11.58 times, though the GuruFocus intrinsic value model suggests the stock is trading at a premium to fair value, a tension worth keeping in mind. On financial strength, the balance sheet is functional and not in distress, but thin cash coverage and moderate interest coverage leave less room for error than we would like. On profitability, this is the core vulnerability: thin margins across the stack and a return on invested capital below what most institutional frameworks consider value creating. Refining margin recovery is the key unlock. On growth, the 3-year revenue decline reflects a cyclical downswing rather than structural deterioration, and the 5-year picture is more constructive. This is a company to assess through the full cycle. On smart money, the picture is genuinely mixed. A respected value investor is adding, but insider selling outpaces buying and broad institutional conviction is low. The overall StokTok score of 51 out of 100 places Phillips 66 in hold territory. In our view, the thesis rests on a refining cycle recovery and continued capital return discipline, while the bear case rests on sustained margin compression and weak top-line momentum. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Phillips 66. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.